Welcome back, everyone. Danny, we have a very controversial topic today.
Oh boy, do we.
Yeah, it's one of those topics that no matter what side of the spectrum you fall on with infinite banking, as you can see from the title, there are very passionate people about this topic on both sides, right? People who think it's the stupidest thing in the world, it's a complete scam, all the way to people who, on the very, very extreme side, follow it almost like it's a religion, right? Like it's really, and then there's all kinds of people in between, right? It's just
extremism on both sides.
Yeah, and unfortunately, the topic has just become so polarizing that I find it very difficult to find any space online where there are people who are trying to approach it in a fair, reasonable way, right? Like I fully admit, you and I have opinions about it, right? But I'm saying it right now from the beginning to our listeners. We're going to try our very best to be as middle of the road as we can. Yes, we are going to have personal biases. We're going to have certain opinions that agree or disagree with certain listeners or people, and that's okay. But I don't know, Danny. I mean, when I'm looking online, like even like YouTubers that I really like the Money Guy Show or other places, it's just very difficult to find something without the person's opinion just being like one extreme or the other.
I agree. I think most opinions that you find are very polarizing, and they're gonna swing wildly one way or the other.
Yeah. So again, like we saying the same thing I did when we were doing the velocity banking episode. I want to try and find the truth somewhere in the middle and see if we can give shed some fair light on both sides of the equation, and let our listeners know where we stand on it, and just give our honest thoughts. So I think this is a great time to jump in, Danny, to setting the stage for our listeners, giving some context, giving some disclaimers. So to our listeners, we're going to spend a few minutes here, 5 minutes maybe. I'm going to try to keep it concise, but I think it is very important to plant some flags, set some expectations, give some context, disclaimers, to make sure that this is just one of those topics that you get far enough into it as we're going through it, you're going to hear something you totally disagree with at some point. Somebody, no matter what side you fall on. And it's very easy to let your emotions get the best of you, and then just immediately you've made up your mind that this person, this is what they think about this thing because they said this one thing. And I want to try to plant some flags now so that our listeners don't forget kind of some of the fundamental thoughts we have on the topic, beforehand. So,
definitely. And going into that real quick, if you agree or if you disagree, let us know, and we do our best to get back to everybody.
Yep.
And definitely engage with those comments, and we want to hear your opinion.
Yeah. So let's start with the disclaimers, Danny. Number one, we're not infinite bankers, right? Nor do we claim to be experts at it. We're not practitioners of the infinite banking concept. Number two, we are not insurance salesmen. So anything positive we say about particularly whole life today, because that's generally the focus that infinite bankers talk about, is using a whole life policy. Anything positive we say should not be skewed in your mind that we are trying to pander or sell something. We are not insurance people. So you can't claim that we're trying to sell a product, because we don't sell products. We don't earn commissions. There's no conflict of interest there. Our thoughts are our honest thoughts on the matter. So just want to make sure that's aware. And I want to give a message to kind of two groups, right? The fee-only financial planners, to a message to our fee-only financial planning friends, and a message to our insurance agent friends out there, okay? First, I'm going to start with the fee-only financial planners. This is the camp I fall in. I'm a CFP practitioner, certified financial planner practitioner. I'm a CHFC, chartered financial consultant, and I'm currently almost done with my chartered life underwriter, CLU designation. That's right. I'm an insurance nerd. I like insurance. I'm fascinated by it. And I'm not an insurance salesman. I'm still fee only. I'm one of those rare oddballs that was curious enough to dive down that rabbit hole and learn more about the insurance industry.
So nerdy, you just go after additional education for fun.
Yeah, and I don't throw my designations out there to flaunt that I have more education than other people. I'm actually very against that culture that some financial planners promote, that, very rarely do I ever talk about my designations on the podcast, right? Because I think there are just smart people out there, and you should listen to people and what they have to say and allow the merits of their message to come through, designations or not, right? That doesn't really mean a whole lot. I think continuing education is important. I mentioned them out there to let people know that, like, hey, this is my area. Like, I'm very interested professionally in this area. This is what I do, but I don't want to flaunt that. So to my fee-only financial planning friends, I agree with you that the life insurance industry has a lot of issues with it, particularly when it comes to sales tactics and promoting products that are not always in the best interest of our clients, right? I totally get that. I totally empathize with you, and I get very frustrated when we as planners do a lot of planning work and somebody comes along and earns a big fat commission for a lot of work we did. I get the frustration. I also get the frustration with some of the antagonizing messages the insurance industry likes to shoot at us about us earning AUM fees or having a focus on investments or financial planning, and saying we're incompetent or not skilled or knowledgeable enough in the field of insurance. I understand your frustrations, but I'm hoping that you'll realize through this conversation today that we also have to listen to some of the wisdom and facts about the insurance industry, right? My goal as a practitioner is I hope to actually build a bridge between the financial planning, hardcore comprehensive financial planner side who are fee only and the insurance industry. Like, we should all be working together. We should not be enemies of one another. I guess I'm starting to bridge into that. That message also goes to my insurance agent friends. My message to the insurance friends out there who work in the insurance side of things. I understand your frustration with my side of the field. The constant referencing to insurance products as being scams, as being bad decision of your money, oversimplifying the products and making broad brushstroke claims about life insurance or annuities that are just flat out not true and wrong. I see that a lot on the fee only side, who say that the entire insurance industry is chalked up to nothing more than selling on people's fear. Like, that's all they have to offer. There's no real product there. You're just scamming people who are too afraid to understand the market, and that's how they get you, right?
I mean, if you want to say that they're selling on fear, the other side could argue that everyone else is just selling to greed.
Correct. Yeah.
Yeah.
So, like, I really do understand you. Like, I have met some incredibly intelligent and talented, I'm going to call them planners on the insurance side, even though they're insurance agents, right? Just really amazing people in that field. And when we as financial planners on this side of the aisle throw so much shade at them, we are discrediting. We're not giving enough credence to the real talented people out there who are in the insurance field, who are actually trying to do the right thing and actually know those products inside and out, and also understand how they operate, the mechanics behind them, and how they're applicable to people's financial lives for their benefit. Okay. Like, I really do see the frustration on both sides of the aisle, and I'm hoping that we can just like be honest with one another and just, meet halfway. So, wanted to plant that flag. I know I went off on a tangent there, but it's something I'm very passionate about. Another disclaimer: whole life insurance and infinite banking often get conflated into one thing, as if they can't exist without one another. And that is something I want to dispel. They are not the same thing. Whole life insurance is life insurance, and it has its practical applications, and it stands on its own merits when it's applicable to someone's financial plan. You don't,
which we will get into.
We will get into, yeah. And you don't need infinite banking to convey that message. So I just, infinite banking is very much a philosophy. It's a certain way of life for some people, but I just don't want people to be mixing them together. I mean, Danny, I was at a conference one time, and I was talking to some insurance guys, really nice guys, and they don't sell whole life. They sell term. I think they do some like universal life or maybe index universal life.
Sure.
And I remember one time I brought up whole life. I just like, oh, do you guys sell whole life? And I kid you not, the first question out of their mouth to me was, no, we just don't really see it being advantageous compared to other products. Why, are you like a infinite banker or something? And I remember I was so
Interesting.
I was so confused.
Okay.
I had not even heard the term before, and I was like, no, like I don't know what an infinite banker is. I was just asking if you sell whole life. So it's so funny how they just seem to be melded together. You should be able to separate them apart because they're entirely different things. So that's an important disclaimer I want to make. Another disclaimer to the infinite bankers out there: yes, Danny and I have both read Nelson Nash's Becoming Your Own Banker, 6th edition. We read the entire book, both of us, in preparation for this episode. So please know that we have gone through the effort to carefully read it and see what we like and don't like about it, and see how it might give us a better understanding of where the infinite banking people are coming from. So we will get into that later on in this episode as well. And then the last one, very quickly, for purposes of this episode, we're only going to talk about whole life insurance. There's some people out there who are infinite bankers and like other types of life insurance. I don't want to muddy the waters. I want to keep this focused. So for the purposes of today's conversation, when we reference whole life, we are specifically referencing the big mutual participating whole life companies. I think, like New York Life, Mass Mutual, Guardian, Northwestern Mutual, Penn Mutual, all the big mutual companies. Actually, Penn Mutual is not very big compared to the other four, but you get the drift. We want to keep it focused. So just know by default, that's what we're referencing to, those types of companies, participating mutual whole life companies, meaning policy owners are the mutual owners of that company. We're not talking about whole life that's issued by stock companies where the policy owners are not mutual owners of that company. Just wanted to plant that flag. Another area I want to go into really fast. So you know that I am staying on top of conversations in this sphere. I do follow experts in the life insurance field. I do follow life insurance agents. I wanted to give a quick call out to some so that you can get an idea of kind of the flavor of people I'm following and that sort of thing. So first I'm going to start with some experts that I really recommend you check out. First one is going to be Bobby Samuelson, BobbySamuelson. He is an independent product developer and consultant. He founded the company Life Innovators. He is highly respected in the insurance industry. He does not sell insurance. He develops products. He helps companies develop products. So he does not sell products. He is very intelligent. He is very honest and transparent about the industry. He'll be the first in line to bash his own industry and talk about a lot of the negative things going on. But he also appreciates so many of the nuances and the beauty behind actuarially designed products and the benefits they provide to families.
So I believe one of his biggest issues is insurance being sold as an investment.
Yeah, absolutely. And he also really hammers down on people over relying on illustrations to sell products, when he was like, his whole thing is like, the illustration should really just be there to help someone explain how the product works. But he's like, I guarantee you what the illustration says, the product's not going to do that. It's just not going to do it. That it's just an illustration, but people are pretending it's like a projection of what they're expecting to happen. And he's such an honest, transparent person. Really recommend you check out his stuff. You can find him on some interviews on YouTube. He doesn't show up very often. He's pretty quiet and pretty private, but he is cropping up on YouTube here and there. Very, very much worth your time. The other one is Dr. Wade Pfau, W-A-D-E. Pfau is P-F-A-U. I think the P is silent. He's a professor. He also is a financial planner. He has a practice in Northern Virginia, I believe. He's a professor at the American College of Financial Services, which is where I did my chartered financial consultant designation from, and it's currently where I'm doing my chartered life underwriter designation from. He is an academic leader and researcher in the financial planning field, specifically in retirement income. He has made really compelling cases for using insurance products, whether it be life insurance, he's referenced whole life before, or annuities, as a buffer asset or as an income floor. His research is so well conducted, it's so thorough, and he provides real empirical evidence on how these products can actually, over more market scenarios, provide better outcomes for families and risk mitigation. It's really fascinating stuff. And as a fee-only practitioner, I remember when I was going through the CFP curriculum, I kind of had, an attitude about insurance at the time, because the teacher I had was not very kind towards the industry. And so I had these preconceived notions, right, about life insurance and annuities and things like that. And Dr. Wade Pfau really, when I've read some of his books, I've watched some of his lectures, his webinars, I was truly humbled as a practitioner. I was like, wow, I have been unfairly discounting insurance. This is earlier in my career. And one of my duties as a CFP practitioner is to be objective. And being objective means we need to actually fairly assess what things are and what they do, and not allow and we have to remain impartial, right? We have to be as unbiased as possible. He was really a big key person that helped me break through a lot of those biases I used to have, and see the value in using insurance products to augment, to supplement your financial plan when it's appropriate. Really, really good stuff. The last one I'll throw out really quick on the experts is Scott Witt. I believe his last name is spelled Witt. He's an actuary. He used to be an actuary for one of the big mutual companies, I think. He's now a fee-only insurance consultant. You heard that. A fee-only insurance consultant. He does not sell insurance. He is for a fee only. He will be a consultant on helping people decide on insurance products that are a right fit for their financial situation. Very, very unbiased, just very objective. And he has a lot of really intelligent and impactful things to say on life insurance and annuities, and specifically on whole life as well. So really good experts. I also want to give a quick call out to some life insurance agents that I have a lot of respect for. I will admit I have differences of opinions with these life insurance agents on some things, but more or less, I agree with a lot of the things they say. First call out is Brandon Roberts and Brantley Whitley at the Insurance Pro blog. They do like to poke some fun at CFPs quite often. It's okay. I take it in stride. I do understand where they're coming from and their frustration with the CFP side of the industry. That's often very anti-insurance. I don't agree with everything they say, but they are very intelligent people, and they provide a lot of value in educating on life insurance products and also annuities. Another one is Steve Parisi from IBC Global, which is Insurance Business Concepts Global. One of the most transparent people I've ever heard on YouTube about whole life insurance, flat out sharing what commissions are, explaining why he deliberately takes cuts in commissions so that policies are for the better of the policyholder. What an honest and transparent person. I may not disagree. I may not agree with everything he says, but I certainly respect his intelligence, and I have learned a lot from him. I've learned a lot from all of these people I've mentioned. Last one is Caleb Gilliams from Better Wealth and the And Asset. He runs 2 YouTube channels. He and his team also produce a lot of really good content. I think they are practitioners of the infinite banking concept, but I think they also...
I believe so. Yeah.
I think they are, but I also think they are very middle of the road. Like, they're very fair, and they call out a lot of
more
the
realistic about it.
Yes, very much so. They call out a lot of issues they see. I've learned so much from everybody I've just mentioned, and I think they're worth... This is not an endorsement for anyone to necessarily go work with any of them or buy insurance through any of them. I'm just saying I really respect their intelligence and what they bring to the table to help educate people on the topic. It's worth checking out their content. Okay, I know we spent a lot of time, so we're going to jump into the real conversation now. First, let's talk about whole life for a second. Danny, I mentioned earlier, I really want to separate whole life insurance from infinite banking, because I think we should.
I'm going to cut in here and say, in order to understand infinite banking later, you need to have a grasp of what whole life is, what it does, and how it's used.
Yeah, I agree with that. So for starters, I just want to throw this out here. Danny, you and I were talking about this off mic one day, just about how how beneficial.
I was like, what is the deal?
Like, life insurance is actually very beneficial to society. Like, taking a big step back, like I really think it is hugely beneficial to society. I actually think that if anybody who has a family or a spouse or a child or anybody that depends on them, that would be impacted if they died and they lost their income, they should have life insurance. Like, that is a fundamental thing for family households, is to have something to help your loved ones should you pass away. For most people, term life insurance is a very easy way to get across that, right? Because you're just buying it for a period of time. And
with the concept that your assets will be high enough after that term to, support your loved ones in your absence.
Yes.
And something that I had heard recently that I found interesting was the concept that when you have a group of people buy insurance through a company, you are creating this risk pool, and essentially You are reducing everyone's overall risk by spreading that risk across the pool of insureds, like of people who are insured. And in that way, you're also reducing and spreading the impact of a single passing across everyone. And that's what kind of it lends itself to the stability of society, which is something I had never considered, before I started diving into this world.
Yeah, I mean, I couldn't have. I'm like laughing and smiling because I'm giddy with how you said that. I agree. I couldn't have said it better myself. Like, there's something really powerful about that. Like, there's a community of people pooling their assets together. They know that some of those people will die before life expectancy, some will die around life expectancy, and some will live beyond. And it's the mismatching of those life expectancies that allows those pooling of assets to, people who die early end up being more costly, right? Like, because the death benefit has to pay out sooner. But the people who meet life expectancy or go beyond, they paid premiums for longer, perhaps, or the premiums they did pay had longer to be invested and generate more more cash on the general account for the insurer to offset the net amount of risk. And so it's just a neat. It's worth appreciating, right? If you can understand that basic concept, that benefit to society, I think that's the first step in the right direction to like start to see the forest through the trees when you start talking about individual products, that type of thing. So let's talk about whole life, right? So with whole life, I'm going to assume that a lot of people here today listening, I don't want this to be an introduction to whole life and like explain from start to finish. I'm assuming that our listeners have some basic idea of what it is. If you are brand new to what whole life insurance is, you may need to go supplement some of your learning on it. You might not get everything in this episode because we're assuming you already have some knowledge, but it is a very flexible tool, right? Now it can be as flexible or as inflexible as you want to make it. A lot of people, there are a lot of ways you could structure a whole life policy. There are all kinds of different riders you can attach. There are all kinds of different premiums. There's base premium, there's paid up additions premium. You can blend a term rider in it. And all these things, all these levers you can pull can make it something, achieve something you want it to achieve, whether it's focus on death benefit, whether it's a focus on accumulating cash value, or some in between, if you will, some sweet spot. Now, the idea is what's different about whole life than term life is it's in force for your whole life. This is a permanent policy, right? So you can pay premiums over 10 years and then it's done and in force for your whole life, over 20 years and then it's done and it's in force for your whole life, or you could pay premiums over the entirety of your lifespan until the day you die. Obviously, if you decide to pay fewer premiums and then be done with it, you're going to have much larger premiums up front versus if you spread them out over your entire lifetime, that type of thing. But the whole point I want you to walk away with is it's actually quite flexible as a policy to design it to meet your needs. And it's a very powerful tool. And I'll give you some examples from a financial planning standpoint. Estate planning, right? There may be a client, admittedly, this is for higher net worth clients, but there may be a situation where they may be dealing with estate taxes. And so having a death benefit that pays out in a lump sum at death could provide a lot of liquidity to heirs to pay for expensive estate taxes that are owed. Another thing could be not necessarily an estate tax issue, but just an estate illiquidity issue, right? And I've met families in this situation who all of their assets are tied up in, the farm or in real estate, right? These illiquid assets that, they die and then they have all these assets and the heirs are like, what in the world do we do with this? We have no liquidity from this. We have no cash on hand. Having a permanent life insurance benefit that is there when someone dies, right? A term's not going to cut it because that's 99% plus of all term policies in force do not pay out, right? But 100% of permanent policies in force, that's the key word, in force. I'm not talking about lapsed that people cash out. 100% of in force permanent life insurance policies pay out, assuming that it wasn't denied due to somebody who committed fraud when they took out the policy, right? So it's a powerful tool for those types of estate planning needs. Also very powerful for business planning, right? If you are in a partnership with somebody and you are concerned about one of the partners dying and that partner has a spouse and that spouse is entitled to their now deceased spouse's pro rata share of that partnership.
Mm-hmm.
How do you...
Their portion of the company.
Their portion of the company. How do you pay that spouse? Something like a permanent life insurance policy, whole life, whatever it is, is a really powerful tool. And so partners will often.
And in that case, the company is the literal beneficiary of the policy. So that correct. So they have the capital, the liquidity needed to basically buy that deceased partner's portion of the company
You're correct.
off the beneficiaries.
Yeah. Oh, we're gonna. I don't want to get too nerdy here. We can't go down this rabbit hole. We gotta keep it focused. But I
Yeah.
will quickly say there are generally two setups with buy-sell agreements and permanent life insurance in a partnership situation or a business. The first setup is that every person in the partnership could buy a policy on one another, which, as you can imagine, as soon as you get to
it quickly
you have so
spirals
many
up.
policies.
It's out of control.
It's out of control.
It's like a spider web. Just
it's ridiculous. Sometimes that is the better setup due to certain tax planning issues and things like that. The other setup is that you have the entity, the business entity itself, own the policy on the individual owners. But the mechanics and how they work are a bit different, and there are pros and cons to each one. But anyway.
Okay.
Another one is, C corporations, right? If C corporations retain cash on their balance sheet, they have to pay retained earnings tax, right? Which is why, business C corporations often want to either pay it out maybe as a dividend or whatever. Like, I don't. It's complicated getting into business taxation, but permanent life insurance that has cash value, because it is technically life insurance, a C corp could buy life insurance on the life of an employee, for example, but it's owned by the C corp. And even though it has cash value, it's not considered cash on the balance sheet, so it's not subject to retained earnings tax. So it's a really unique way to like have cash on the balance sheet, like in an advantageous way. That's definitely outside of my realm of expertise, so I don't know if I'm speaking precisely correctly on the topic, but I do know that that is a concept at play, kind of in that corporate atmosphere, if you will. Interesting stuff. I have not deep dived into that, but anyway, those are like some really unique niche planning situations for permanent life insurance, like whole life, right? But whole life also has a lot of flexibility to be used for just regular individuals. I'm not going to have time to go into it today, but I will fully disclose, as a fee-only planner, right? I come from the side of the aisle where there are generally people who have bashed the insurance industry. I own a whole life policy, and the way I structured it was to be as cash value positive as possible with the lowest death benefit as possible without becoming a modified endowment contract. I'm also known as a MEC, which would make it lose its tax advantages. So how did I do that? I found a life insurance agent who was willing to cram as much of my premium into paid up additions as possible, which has the lowest commission paid, and the lowest amount of my premiums into the base premium as possible, which is the highest part of the commission, and then threw in a term rider to make sure the death benefit was high enough to avoid it mecking when they created the policy. Takes skill, as somebody who, you have to know how to run these illustrations. You have to work with somebody who knows how to do these things.
And you have to work with someone who's willing to take that hit to that commission.
I know.
Correct?
I know that the agent who sold me the policy, we're talking 90% reduction in their commission. Like,
yeah,
90% reduction in their commission for this, right? And so a lot of these agents, because of that, they'll only work with so much premium, right? Because you'd have to sell a lot of these policies if you're taking that much of a hit to commission to like make a living, right? But I was a good candidate, and all I'm using it for is a really cool emergency fund. I have an emergency fund in my high yield savings, and I'm siphoning off a little bit over a 7-year period into a whole life. It's going to be reduced paid up after 7 years. It breaks even in year 4 or 5 if the illustration plays out as it's planned. I'm not expecting it to, because illustrations can change, the dividend rate can change. But by the time it's reduced paid up, I'm more than what my savings account had because it's been growing. I lose a little bit of opportunity cost from some of the interest I was earning in the savings, because you do take a hit in some of the early years of the cash value. In my case, the cash value in year 1 was like 85 to 90% available, and then it just gets closer and closer as it breaks even. But once it's reduced paid up, my cash is all there. It earns a nice interest rate via the dividend. It grows nicely, and it has a death benefit to boot. And the reason I did it was because I had my emergency fund sitting over there, not really doing a whole lot, just sitting in cash. And I'm a big believer in having a well-established and funded emergency fund. But I'm also a big believer in not touching it and leaving it alone to truly keep it there for emergencies. Well, when I took out this policy, this is when interest rates were 1% at most in high yield savings, right?
Yep.
And so I felt, you know what? If I can just siphon off a little bit over a 7-year schedule into a whole life, and by the time it's reduced paid up, it's kicking around at 4 or 5% per year growth once it's reduced paid up. That's a really attractive growth rate. And now it's just kind of a self-contained policy that I can tap into if I need for an emergency, which is almost never, but every once in a while, right? So things come up. And it also has a death benefit. To me, I was very comfortable with the opportunity cost of an emergency fund I already had established that was already in savings anyway, and just siphoning it off into the whole life policy over 7 years. Really cool tool. I'm not a corporation. I'm not I'm not in a buy-sell agreement. I don't have an estate tax need. And I'm giving this example because oftentimes a lot of people will say, the only time a whole life is good for anybody is like after you've maxed out your IRA, after you've maxed out your 401k, after you've done this, after you've done that, and then maybe after you have everything, done and you have a little bit left over. It's like, no, I just gave an example. I didn't have any, I didn't have to sacrifice other parts of my financial plan. I already had my emergency fund established. All I was doing was moving it from one bucket to the other. It was going to sit in an emergency fund anyway. In my eyes, I thought a whole life policy structured in this way would be a really cool asset to have as a unique emergency fund that has tax advantages, flexibility, the ability to either just take withdrawals or policy loans if I want, and we can get into that later. But to me, it was worth that. And so I did it, right? And I'm very happy with it. I really like the setup I have. So I disclose that because, to our listeners on the fee-only planning side of the aisle, I want you to know that I, as a fee-only person, saw merit in that. Okay, like I understand how the product works. I know what it does and what it does not do, and I was comfortable with that. And those on the insurance side of the aisle, I want you to know that I do walk the walk. I'm not just talking here when I say I understand the benefits that whole life could have for the right individual when using it in a certain way that matches their needs. I'm living proof of that. I've literally done that. Okay, so I set that as an example because I want you to know I'm being authentic here. Like I am putting my money where my mouth is, if you will.
Okay, Chris. So we've gone through some of the different situations where you might utilize whole life. We know that you have a whole life policy that was constructed in such a way that that initial 90% reduction approximately in commission, to the agent that sold it to you. So we've gone through that. Let's talk about whole life, or the version of whole life that everyone seems to hate on. Dave Ramsey has gone on many tirades about how much he hates these programs and these different products. So how are they different?
Yeah. So most whole life insurance policies sold out there are 100% base premium, right? It's just all going to the base premium, which is high commission. And when you look at these policies, you're talking $0 in cash value in year one, usually also $0 in cash value in year two. By year three, there's like a pitiful amount, like maybe 10 to 15% of the total premiums you've paid is maybe available at that time, maybe even less by year three, right? And then
Whereas you had 85 to 90% in year one.
In year one, right?
Okay.
Yeah. And then you're seeing these break even. I mean, I've seen them like by year 12, by year 15, it's all over the place, right? And when you actually measure the internal rate of return on the cash value in these policies that are 100% base, oftentimes this is where you hear these stories of like whole life only averages 1.5% internal rate of return or something like that. That is unfortunately what most people have been exposed to when being pitched on whole life. Now, I want to go back to something I said earlier with those niche planning scenarios I told you, like depending on what your goal is with whole life, it may be the case that 100% base premium is the way you want to go. It wasn't the case for me, but I very much understand where Dave Ramsey and the like are coming from when they're frustrated with this stuff. I know people personally who were pitched and sold a whole life in this very fashion and became very upset and ended up cashing it out and were jaded, and it's completely tarnished their reputation of the life insurance industry. And sometimes it's just irreparable, right? Like you hear these stories. And that's often where this starts, is you hear these stories about poor outcomes or just poorly sold products that didn't match the client's need. And that's unfortunately caused a stigma in the life insurance world. Now, when you actually look at these policies that are low base premium and high paid up additions, like in the example I gave you, like you already called it out, Danny, but you're looking at, 80 to 95% of your cash value available in year one, depending on how the policy is structured. You're usually seeing it break even around years 4 through 7, depending on how the policy is structured and what company.
Okay.
You're usually seeing the internal rate of return on the cash value long term, like when you really zoom out, 3 to 5%, depending on the policy, right? And depending on your age, depending on your sex, depending on your underwriting health, right? I'm young and healthy. I took my policy out when I was young. I got the highest underwriting class, ultra preferred, and it's done really well for me. Like the cost of insurance is very low for me because I'm in a favorable underwriting class, and that's also reduced the amount of cost of insurance charges coming out of my premium in the cash value, and that
That
helps
makes sense.
my cash value have a more attractive growth rate. Not everybody's going to be in that same boat, right? So it just depends. But to me, it's like, here's this tool that could supplement for some people, right? If they're the right candidate for it, it could supplement their emergency fund. It could be just a safe place to store capital or for saving for a goal. It could supplement or be a diversification play that sits alongside somebody's bond or fixed income or cash-like instrument side of their portfolio. I get really frustrated along with Dave Ramsey when people try to sell this as a comparison to investments, like in the stock market. Like, I understand stock market returns are not guaranteed. You and I have hammered down all of the risks that come with that and how you cannot expect to have any type of return. Historical data and evidence shows that stocks over the very long term are absolutely likely to crush any returns anybody's going to get from something like a whole life policy, right? There's no comparison. And I think people need to separate that conversation too of like
Yep.
comparing it to an investment. Like that'd be like me putting money in my savings account and somebody going, that's a horrible investment. You can get way more in the stock market. Like, why are you doing that?
Yeah.
Like, what pitiful return? It's like, what?
They're
I'm talking about my
different-
savings. Like, I'm not
Yeah.
talking about my investment
different
portfolio.
products for different
Yeah.
needs and different situations, right?
Yeah.
When we're talking about diversifying and making sure that you have all of your bases covered, you're going to use different methods of achieving that diversity. And, there are absolutely times when whole life insurance or term life insurance or cash and cash equivalents or investments all come into play. It's just going to vary for each individual person.
And a couple quick shout outs before we move on, Danny, just about whole life in general. When these are structured, properly, if you're focusing more on the cash value, which is what the infinite banking side of people are doing, right? They do promote this idea of, having more paid up additions and a lower base and having a term rider. Everything I just discussed. In all fairness, that is a flavor from infinite banking. Now, there is disagreements among infinite bankers about how much should go towards base premium versus paid up additions. And some think you have to have slightly higher base, to prevent the policy from mecking, and it has better long-term performance. I don't know if I agree with those things. There are other industry experts who don't agree with those statements, but people can agree to disagree. I think at the end of the day, when you're looking at these policies in general that are structured to have more cash value and lower death benefit, they start to be more comparable to things like your higher yield savings or like your bond fixed income cash-like instrument portfolio. They're nowhere near stock market potential returns. They're usually in that 3 to 5% range that I've seen, at least in illustrations. But what's unique about it is you have something that's comparable to those things I just mentioned, but also has a death benefit, but also is tax deferred, right? Dividends that pay out and growth in the policy is not taxable, like something like CD interest or bond interest in your taxable account, for example. You can take withdrawals just like any other account you may have, but you can also take policy loans and use your cash as collateral, right? And that's an interesting flexibility. In fact, something I just learned in my course I just finished, legal aspects of life insurance. If a life insurance policy has cash value in it, a cash value component, it is required by law in every state that the insurer must include a policy loan provision in the policy for the benefit of the policy owner. It's required by law. It's just like there's so many interesting things built in to favor the policy owner that gives them a lot of flexibility. And I think a lot of that stuff is underappreciated when all you're hearing are these horror stories about the bad type of whole life that might be sold to somebody, and they just kind of gloss over all of these interesting flexibility
Yeah.
features that people have. So
I'm gonna jump into the flexibility side really quick, because
sure.
this is something that tripped me up for a while until we kind of dove into it a little bit deeper off mic. That's the idea of the whole life policy loan, right? And this is how you can use it as an emergency fund. I didn't quite understand, and it really helped. But essentially, you can take that loan, and normally with a loan, you would think, okay, I had that distribution, I have the money in hand. Now I need to start worrying about making monthly payments back, right? The difference with the whole life policy loan is that you do not have to make monthly payments.
Right.
Technically, you don't ever have to pay it back, but then that would eventually lead to your concern about it lapsing when the interest on the policy loan eventually exceeds the cash value.
Correct.
We can go into that some other time.
Yeah.
But basically, it gives you the freedom to take a policy loan, use it for emergencies, and then when your cash flow is healthier, sometime down the line, you can begin paying that back.
Yeah, that's what's unique about it, is that there is no underwriting for the loan. There's no credit score check for the loan. There's no hoping that you get approved for it. There are situations where they could potentially delay it or not approve it. I've never personally seen it happen. I've never heard stories of it, but I guess if somebody was like horribly abusing the policy and doing something really shady, perhaps the life insurance could, but you're likely not going to get any issues. And there's no repayment schedule. There's no minimum payment required. You might be wondering, how is that possible? Well, here's why. And this is an area that gets a lot of criticism from people who do not like whole life insurance. They hear the word loan and you have to pay interest to the insurance company, and they just immediately think it's terrible. It's important to understand what's actually happening behind the scenes, right? So for easy math, if I have $50,000 in cash value in my whole life policy, and I take out a loan of $25,000, right? So I've loaned out 50% of of my cash value as collateral for this loan. That policy is still getting a dividend credited to it annually and growing on the 50,000, right? That 50,000 is still there, like as a number in the background. So yes, I have to pay interest on the $25,000 loan I collateralized against my cash value, but that full 50,000 in cash value is still growing and earning interest in dividends.
Yeah, it's like that 25,000 loan sits in its own silo, which has interest accruing, and then you have the cash value that also has interest growing.
Right. And so one way you could look at it is, yes, your loan's growing, but a lot of the interest and or dividends that are being credited to your policy are really helping offset and wash a lot of that interest away. Now, they're not always equal or perfect. Sometimes your interest rate is a little bit higher than the rate that your policy is growing. Vice versa. There are times sometimes when your policy is actually growing at a better rate than the loan interest rate is. I wouldn't count on it. I think general rule of thumb is just you should expect they're pretty close, but just assume that the interest rate's probably going to be a little bit higher in many cases. In that scenario, it's going to take a long time for that if you're assuming you're not like loaning all of your cash value out all the time and not making any payments, right? If you're using it every once in a while for an emergency or something you need some liquidity for, and you're leaving ample cash value in there, you're not loaning out the entire policy, it's going to take a long time for that loan to catch up to the cash value because the entire full cash value is still being credited with that growth, right? So that's something that also gets underappreciated and just misconstrued by a lot of the naysayers. Like they paint
or even misunderstood.
Right.
Yeah. I think it's a pretty difficult thing to understand.
Yeah.
If you're just looking at this like on the face, on the surface level,
Right.
We've covered so much when it comes to whole life insurance, what it is, when you use it, the details of your policy, the experts within the actual insurance industry. So I wanna move ahead and just say, what is infinite banking?
Wow, we're this deep in the episode. This is going to be a beast for people. But you know what? People who are interested in this topic tend to come out of the woodwork to listen to it. So here we go. Infinite banking. The primary goal is to take control of the banking function in your life. It's about building capital, having control, and having freedom with your capital and being your own lender, right? It's just taking control of the banking function in your life. So it's not about yields or returns for a lot of people. It's just, hey, I can do this using a whole life policy by putting my capital in it. I have control over it. Now I can be my own self financer. I don't have to go to the bank. I don't have to deal with a lender. And a lot of that comes from kind of the flexibility that we just discussed, Danny, about the loan provision. How there is no underwriting, there is no approval. You just request the loan. There's no repayment schedule. It very much gives you a sense of freedom and control that perhaps you wouldn't see in other types of lending situations. I think that's the best way I could summarize it, is having control over the banking function in your life. Now, how do you do that? You use a whole life policy, build up cash value, take policy loans to finance your needs, and then a big thing that is really promoted in the infinite banking concept is to make loan payments back to your policy. So I know we mentioned a minute ago that you don't have to, but there's one concept that's discussed a lot in infinite banking is being an honest banker and being prudent and actually making payments back to your policy. Some of the examples in the book that Nelson Nash gives is like, if you take out a policy loan to buy a car, look at what the comparable interest rates would be in the marketplace for a car loan as it is. Take that interest rate and actually bump it up a little bit. Like, make your own interest rate, force yourself to pay even higher payments back to yourself, just to be that much more of an honest banker and more prudent with paying back your policy loan so that you're rebuilding that capital prudently. The desired outcome for infinite banking is that you're really doing personal lending on your own terms. Like, you are operating it in full control. Nobody else is making money off of you. Nobody else is earning interest off of you. And your hope is that you have better financial outcomes. From interest you avoid paying to other lenders, by keeping your whole life growing over time, and maybe having some type of arbitrage play there where you have more favorable terms of your loan and how your cash value is growing over time compared to what you would have otherwise paid elsewhere. Maybe there's an arbitrage play there too. That's kind of the general gist, I think. I want to go back to one of the flags we planted, Danny. We are not infinite bankers, nor do we claim to be experts, but that's how I interpreted it, trying to summarize a lot of what we read.
Okay. Maybe I'm jumping ahead, but you had kind of hypothetically split this into soft infinite banking and hard infinity banking. And I wanted to ask about that, but I don't know if I interrupted the rest of your thought there.
Okay. I wanted to say that I made up those terms when I was drafting the outline for today in the episode, but I don't know if those are real terms. But I wanted
Well, they are now.
Yeah, we're going to coin them: soft infinite banking and hard infinite banking. I don't know. I've met a lot of people who like this area of infinite banking. Some of the people I mentioned earlier on YouTube, right? I would define people who are kind of soft in infinite banking as like, they view whole life as like, it's a solid choice for storing capital or cash. It's flexible, private. I have control. I can protect my family with the death benefit. It's just a good foundational asset. They acknowledge it's not an investment, shouldn't replace other investments. It shouldn't be replacing.
Very much not all or nothing.
Yes, that's exactly. Like, they're saying, like, it shouldn't be in lieu of other things you're doing with your finances, your retirement savings, that sort of thing. They very much emphasize, like, let's be smart and practical about it, recognize it for what it is, and if it makes sense for you, good. And then there's like the hard infinite banking, which is like, put as much money in your whole life as possible, open as many policies as you can, open policies on yourself, on your spouse, and your kids. Returns don't matter. Banking system is a scam. IRAs, 401k, retirement accounts, they're all a big scam. Stock market is ridiculous. That's also rigged. The IRS is also a thief. Like, they just steal your taxes. It goes pretty hard, pretty fast, depending on where somebody lies on that spectrum. I don't know. I wanted to kind of split that out to acknowledge that to anybody on that spectrum. Like, I know you exist, both on the soft and the hard side. I've met both of you. Nothing but respect for everybody, but I want to point that out. That, like, so anybody who's, if you're here today listening to this episode, you were drawn in. You've probably heard of infinite banking. Danny and I are going to go into I think we should go into the book soon, right? Becoming Your Own Banker, because that's
Definitely.
kind of the Bible of infinite banking, the source of truth for many people.
Yeah.
So I don't know. I want you to keep a level head to our listeners.
Yeah, we are not trying to attack anybody.
No, not trying to attack anybody, but
we're not trying to offend you.
With any type of concept like this that people get very passionate about, one runs the risk of getting lost in the weeds and going too far, right? And we may be bearing the lead here, Danny, but let's dive into it. Let's talk about becoming your own banker, right? Let's talk about what we liked and what we didn't like. So I want to start with the good. I will admit there are a lot of things I really don't like about this book, but I want to start with the good
Agreed.
things, right? So there is wisdom. There's good points. There's education in this book, right? Like they talk about the banking system, the fractional reserve lending. I forget the exact numbers, but I'm pretty sure it's the case of like if somebody deposits $1,000 in a bank, the bank could probably lend close to 10 grand based on
Yeah,
that
just
thousand.
under. You need to have the 10% fractional reserve
Yeah,
to cover some of those deposits.
right. And it's based on the theory that at any given time, not everybody's going to be running to the bank to get their money. And so there should be enough in reserves based on percentages of people that actually need to go to the bank and withdraw their cash at any given moment. Now, Danny, I will say, to the credit of infinite bankers who have sounded the alarm on this, we did see with the collapse of banks recently, and of course during the Great Recession, but recently with Silicon Valley Bank, right? This is exactly where this materialized. There aren't enough reserves. SVB had too many bonds of long duration, which were
Yep.
crushed as rates went up. The prices of their bonds on their balance sheet plummeted. People panicked. Everyone ran to withdraw. They were forced to sell bonds at a massive loss to provide enough liquidity to meet all of the requests for people withdrawing money, and the banks collapsed, right? That's a real threat. It's a real thing that does happen. The book calls things, it doesn't go into examples, but it starts to hint at that risk by talking about fractional reserve lending, things like that. There were also just things in the book. I actually wrote a couple down here, Danny, I wanted to read that stood out to me as good advice. Like everything you buy, you either finance it and pay interest to someone else, or you forego earning interest or earning a return yourself because you spent the money, right? That's true. Now, I think where that he's trying to go with that is that you can avoid that issue by just putting money in a whole life because the money's earning, but you're also pulling from it to spend, but you're still earning in whole life. I think there's a little bit of gymnastics going on there.
A little bit of mental accounting, a little bit of
Yes.
mental gymnastics there. I mean, in a way, it is true. If you spend, you've lost that capital,
Right.
right?
Right.
You've lost that money, that capital that could have been put to other uses. And that's something everyone needs to ask themselves, are we living below our means? And is whatever we are thinking about buying here worth the loss of return that money could have been put to work for?
Correct. Yeah. Nelson Nash also talks about benefits of life insurance. You and I started to hint at them like being beneficial to society. There's actually a lot of really cool stuff on that topic in the book about like, being a unilateral contract. It talks about actuary science, how you're the owner and the legal rights you're entitled to, all of which are true. He gets kind of nerdy about actuaries and talks about how they're like financial engineers and how they structure policies. All very true. That is an area that is very mathematically sound and factual about life insurance. And it's fascinating. And it's one of the benefits that life insurance brings to society is it's a unique flavor of how these products are designed. The policies get more efficient over time. There's an ever decreasing net amount at risk to the insurer, but an ever increasing cash value and death benefit. When you understand the mechanics of how they work, it's really powerful. So call out to the book for mentioning those things. And I put a quote in here too, Danny, that I really, really loved from the book. I'm going to read it here. The common person, I might be paraphrasing here, but it's pretty close. The common person is obsessed with living for today, that the importance of saving and creating capital is all but a lost value. And I put in parentheses here, 60% of Americans can't come up with $1,000 in an emergency. That was actually talked about on the Money Guy show not long ago. I was like, wow, that's very true. That is a lost value. Like the importance of saving and creating capital. Totally agree. I think there's a lot of wisdom in that statement.
Mm-hmm. And I'm going to say, I think the issue there is threefold, right? I mean, there are issues we have a huge lack of financial education within our country. So people just don't know what they're doing wrong. We also have an enormous amount of advertising and social pressure meant to keep every American spending. And then the third reason is for so many Americans across many socioeconomic levels, wages just don't match the cost of living. And, so there's pressure from multiple sides that really exacerbates that issue and, explains why 60% of Americans can't handle. I think it's actually even lower. I've seen $400 listed as the number. They couldn't handle a $400 emergency.
I agree with you. I thought it was a wise quote, but I also agree that I wouldn't say that it's the single reason that people can't come up that 60% of Americans can't come up with $1,000. The single reason is because they're obsessed with living for today. Obviously, it's a multifaceted issue as you just described. There are a lot of really cool things about those topics that I just mentioned. Talking about the insurance mechanics, the actuaries, just general wisdom, good things like that. Now I want to dive into what I didn't like about the book. Okay, and I hope we've planted enough flags here to meet people halfway, but it is very important to me that I discuss with you, Danny, what I did not like about this book.
Sure.
So I want to be sensitive to this. I respect all people and their backgrounds and their belief systems, right? That's a fundamental right that we have, is to have our own personal belief systems. This book is very ideological to the extreme. It's riddled throughout the book.
Far more than I could have ever imagined before reading it.
Yes, it was a bit jarring because I'm trained in financial planning, and I read a lot of very just objective, dense academic material, and
there was none of that here.
I wouldn't say there wasn't none of that. There are good things in the book, but there are so many things throughout the entire book.
Let me clarify. I would say that none of it was academic. None of the book felt academic to me.
That's fair. Yeah. I mean, just to give you, I have just a laundry list of things I want to say. These are things that are actually in the book, right? Now, there are religious quotes throughout and references throughout. There's praise to Ayn Rand. They're very critical to socialism. They mention the IRS being the biggest thief, the banking system being a scam, tax-advantaged retirement plans, very critical of those, discourage them. Social Security is the biggest scam. Now, I don't care what someone's religious or non-religious convictions are, nor do I care what somebody's political views are. I'm critical to all kinds of things, but to me, it just seemed odd that this was the place that they were being presented in, and it didn't feel impartial. It didn't feel unbiased. It felt very biased, and it was jarring to me. I wasn't really sure what to make of it. Right, it just made me question, is this person trying to convince me on the intellectual merits of whole life and this unique way of viewing it, or are they being driven by some deeply held beliefs? And I even sensed anger and frustration coming out. Those are all normal things as a human. I respect those things, but I don't know. It was difficult to read some of that, to be honest.
One of the things I took from it, and that gave me kind of cause for concern, is it felt almost as if the way the book was written would make it easier for insurance agents to sell this concept within religious institutions.
I don't know. Maybe. It certainly seems like it could have been. He does. I mean, some of it was just, I don't know, on that topic, right? One thing that was brought up several times in the book was this. It was this concept is understood through prophecy, logic, reason, and prayer. He mentions that several times. That's, if that jives with someone, great. It may not resonate with everybody. What kind of audience are you trying to speak to here? That was interesting. The other thing too is he criticizes all these things, like the IRS, the banking system, tax advantage retirement plans, Social Security. The life insurance industry is no saint either, right? At the end of the day, insurance companies are just as susceptible to controversy and fraud as any other institution, right? There's a book I call out if anyone's interested. It's called The Story of Life Insurance by Burton J. Hendrick. It's published in 1907. Really fascinating.
It's an oldie.
Book. Yeah, it's a great book. Highly, highly recommend it. I heard it from Bobby Samuelson. He recommended it on a video. And it talks about all the stuff that was going on. Horrible, horrible stuff in the life insurance industry that was going on, much of which still happens to some extent today. But it also helps paint the picture of how, there are very noble aspects of the insurance industry, right? yeah, we can have criticisms about the IRS and the banking system. We can even have criticisms about retirement plans or social security. But there are also some good things in those things too, right? Like, I don't know. I'm not on board to bash all of those things, but then hold life insurance companies somehow in some like special space, and the infinite banking and whole life is somehow immune to all criticism in that regard, or somehow has an ethical superiority. I'm not convinced of that. Back to the religious thing. There's a lot of language used about like, if somebody doesn't understand this, then explain it to them again. And if they still don't understand it, well, then they're either unteachable or they're a thief. It's like, that's like language I hear like somebody uses in a cult for an apostate, like who's being sent as an outcast. It's like, you're a
Yep.
sinner, right? It's like,
You make anyone who doesn't agree the
right,
other, and it makes it very easy to insulate those beliefs because you no longer interact with anyone who's who believes anything to the contrary.
right. And they don't use the word if they don't agree. They say if they don't understand,
Yep.
they're either unteachable or a thief. But I can't help but feel like they're saying if they disagree with you, yeah, maybe too. I guess what I'm concerned with a lot of this ideological presence in the book, it's this kind of language that fuels the fire for a controversy that can really split people apart, right? There are a lot of people in this space who take this as like the source of truth of infinite banking, and any criticism dare one say towards it, you shall be outcast, as an apostate. I have met people like that. Now, I want to say again, I'm not speaking to everybody out there. I'm giving an example of something that I personally consider to be on the very, very extreme end of the spectrum, right? But I see this in this kind of language, and I'm just shocked because I don't know. It seems to be muddying the waters with trying to have an honest conversation about some of these concepts, and I'm trying to find middle ground here. These are just a lot of things I really didn't like about the book. It seemed to take away from the merits of using whole life insurance for the right person, right? Like, I think that the product speaks for itself. It stands on its own merits. I don't have to invoke ultra criticism towards other institutions or people who have different opinions from me to support my claim in the validity of its usefulness, right? Like, just speak to the
Definitely.
product, speak to what it does, and the merits should speak on its own. That's all I'm gonna say.
Okay.
I hope we didn't offend anybody. Certainly didn't mean to, but it's in the book. Like, it's all over the
Yep.
place, so it's kind of hard to avoid not talking about it, right?
Yeah.
So
So we've touched on some of the positive things in the book, and then the parts of the book, the aspects that we did not like. Looking at how infinite banking has evolved from that initial work, what do you think the misleading statements or the harmful myths or faulty logic kind of surrounding infinity banking are?
I'm laughing because you keep saying infinity banking.
That's how I see it. I see it online as
Yeah.
infinity banking all the time. So yeah, we are talking about infinite banking. However, so many people say infinity banking. I'm kind of going back and forth saying both.
I just learned something new. I've always called it infinite banking. I think this just yet again shows that we are not we're not in that space. But so yes, misleading statements. Some of the harmful myths I hear. I think the biggest one, Danny, is this idea of taking a policy loan, and the idea is it's being conveyed like you're paying yourself back interest, and that's not true. The way a policy loan works is you are literally taking a loan from the life insurance company's general account. They are issuing a loan of their cash, right? Then they are using your cash value as collateral. Basically, if you never pay the loan back and you die, they're going to go, well, we're paying your death benefit out to your heirs, but you had that loan, so we need that. Or if your policy lapses and maybe you didn't die, right? You just the loan blew up and you never made payments and you used all your cash and you used the policy irresponsibly. Well, they're going to say, well, we collateralized your cash value, so we're going to recover that loan from your cash value. That's all it is. You're taking a loan from the life insurance company, not your policy. In other words, you're not taking a loan from yourself. And then you pay interest back to the life insurance company. Interest accrues with them. It does not accrue for yourself, right? It's different. But I often hear people talking about this idea like, Well, yeah, you just take a policy loan, your policy is still growing, and then when you pay the loan back, you're actually paying the interest back to yourself. That is just completely false. Like, and it's actually harmful to promote it that way. It's
Yeah, I think the concept for that comes from the fact that it's a mutual participating policy with a mutual company. So when you pay back with interest, that is profit for the company, and then they are theoretically issuing dividends, right? You're earning interest on that. But if you really want to look at that realistically, it means if you're paying 6% interest on this loan, are you getting a fraction of a percent back in the equivalent, like when you receive that dividend? You can't really say that you're paying yourself back with that.
I'll admit I had never interpreted it that way. I think you are right that like you're paying interest to the life insurance company, and so you could say that some portion of that perhaps makes it back to you in the dividend payment as part of
I
the
mean, if
profits.
you want to be really pedantic, you're really paying back every other person in the insurance company with that interest, not just yourself. Right? It's fractionalized across tens of thousands of people.
I think that may play a role in people's interpretation of thinking they are paying themselves interest back. I've always thought it stemmed from the idea that your entire cash value is still being credited growth despite the outstanding loan. And because that growth kind of offsets some of the loan interest anyway, it's like, yeah, you're paying loan interest, but like they're still paying you a dividend on your cash value despite the loan being outstanding. And so maybe that plays a role in it too. We should have mentioned this at the beginning of the episode. We're way deep in the bonus round. We still have more to go, but we haven't discussed direct recognition and non-direct recognition. That's a whole rabbit hole we don't have time to go into. Non-direct recognition basically means if you have an outstanding loan on your policy, the portion of your cash value that's collateralized for that loan is attributed the same dividend as the portion of your cash value that has no outstanding loan collateralized against it. Direct recognition means that any portion of your cash value that is collateralized for a loan gets special treatment. It's a different dividend calculation than the non-collateralized portion. And that could be to your benefit or your detriment. Sometimes they decrease the dividend, and in some weird cases, they increase the dividend if the loan rate is higher than the dividend rate. We're not going down that rabbit hole, but I just wanted to call it out so our listeners were aware. Yes, we do understand those are factors that come to play in this type of thing, but everything we've said still stands in terms of the basics here. Let's go to another one, Danny. So I already hinted at it earlier when I was talking about the things I didn't like about the book, but it paints life insurance company as an exception to the rule, right? Like life insurance companies, the whole idea is like you're your own banker and you're self-lending. Well, what I just described to you, you're not self-lending. The life insurance company is lending money to you. That's what a policy loan is. It's not a loan from your cash value. It's a loan from the life insurance company. But a lot of the language used in the infinite banking concept is this idea that you're self-lending, you're self-financing. You technically are not. That's not what's happening. Yes, loan provisions in a whole life policy are very flexible. We've already acknowledged they don't require underwriting. They don't have a credit score check. There's no terms on the loan. You don't have to make payments back. There's no payment schedule. Yes, those are all more powerful elements of control beyond typical lending situations. But it's still not self-lending. It's still a loan from the life insurance company. Just want to make sure we are honest about that. And life insurance companies, like I said earlier, Danny, they're susceptible to the things that any other company is susceptible to: mismanagement, poor handling of finances, corruption, unethical business practices. These are all human beings. And not only that, but life insurance companies can still experience a run for the money just like banks can, right? Now, I acknowledge that the risk is greatly mitigated when you're working with a big mutual life insurance company. I understand it's not a perfect apples to apples comparison to, say, banks, for example. But
I want to jump in here to something that you actually kind of taught me or opened my eyes to recently, is the fact that there are insurance companies that literally have higher credit ratings than governments. And some of these companies have existed for hundreds of years, longer than many governments. So many of them are very good at what they do and very, very smart with the actuarial science. and they're trying and successfully running a large, long, long-lived business.
Yeah, I mean, they're very much thinking like a 100-year plan, not the 5-year plan. Like they're very much stable. It's amazing. I very much deeply appreciate that aspect of life insurance, and so I acknowledge that. But I still just I want people to be honest. Like these are still companies, and they are lending you money, not yourself, right? There's a misunderstanding there that gets communicated in a slightly misleading way when I hear people talk about the infinite banking concept. The other thing I'll mention too, Danny, to a point you mentioned just a minute ago about how maybe incidentally you paying loan interest to the company, a tiny fraction of it makes itself back to you. I want to riff on that for a second. I truly believe that somebody has a whole life policy with cash value with a loan provision that they can tap into if they need it. I really do think it should be a use it once in a while if slash when you need it. But a lot of infinite banking people are promoting it like you should run all your finances through it. Like you should operate it like it's a bank account, very similar to how people will with a home equity line of credit with
With
velocity
velocity
banking.
banking.
Yeah.
Yep.
And this is one of the benefits of having a deep appreciation and even understanding of how life insurance companies materialize profit, how their general accounts are, the game that they operate in. Taking policy loans left and right may not actually be good for you or the life insurance company, right? Like, yes, you're paying interest to them, and sometimes that interest is higher than what you're seeing on the fixed income options out there, bonds, CDs, whatever in the marketplace, right? But insurance companies are not in the game of buying and selling bonds. Most of their general account is in bonds, right? But when they buy a bond, they are freaking holding that thing to maturity, right? Like if they buy a 30-year bond, you bet you 99 times out of 100, they're holding on to that bond for 30 years and collecting every interest payment until the day it's done. When you are taking policy loans out, the life insurance company has to pull those funds from somewhere. And if too many people are requesting policy loans too frequently, there is a risk that the life insurance company would have to tap into bonds or assets that may not be advantageous to liquidate and sell just because you need a policy loan. That is a real risk, and it's a much broader risk, right? But it could affect the overall growth investment performance of their general account if too many people are requesting policy loans. So this idea of like promoting infinite banking that you should just like I mean, there are some people out there who are going nuts with policy loans. Like it's just too much, right? Like I really think it should be used for like that's why I use mine as just an emergency fund. It's a self-contained emergency fund. That is what I have established it for. That's what it functions as. And
Mm-hmm.
emergencies don't happen very often.
Yeah,
And
you likely use it in the same way that you would otherwise utilize a HELOC, where
right,
you have the HELOC, but it's at zero.
right,
And if an emergency happens, then you tap into it.
right.
But you're not running your finances through it.
Yeah, absolutely. And so I think I think those are some of the big things I wanted to call out that can be misleading or harmful that are being promoted. Who might it work for, Danny? I think that's important to talk about. Who might infinite banking work for? I think another way I want to phrase this is who might consider a whole life policy. I'm gonna phrase it both ways, right? Because I want to be respectful to infinite bankers, but I think someone who wants a safe, liquid place to store savings or capital, and they want a death benefit to protect their family. I fell into that category, right? I wanted a safe, liquid place that had some tax advantages and flexibility with loan provisions, and had a death benefit, and it operates as my emergency fund. I was the candidate for that, and that's why I went
That
that
makes
route.
sense.
So, if you're someone who values privacy and having more control, less restrictions around lending and that type of thing, and you're comfortable with giving up on certain opportunity costs, right? Certain opportunities out there, then maybe that speaks to you, right? If you're someone who cannot and like will not trust other forms of investments, like you just for whatever reason you just cannot stand stock market, real estate, whatever it is, other securities, then maybe this is something you consider. Danny, this is another one that you and I talk about a lot. I want to call this out again because I hear it online a lot, and I do like the term investor DNA, right? Everyone has a different investor DNA. If you are someone who truly have behavioral finance struggles, and you get very stressed with market volatility, those types of things, you continuously make mistakes and make bad decisions at the worst time. supplementing your financial plan with something stable like a whole life policy, maybe that's something you look into. You may be a better candidate for something like that to help augment some of that behavioral finance stress.
I think that's one of the things that people typically try to view the premium as, right? It's a form of enforced savings.
Yeah, it's a forced savings. Yes, I love that. Yeah, I think for people like that too, who I want to talk about the buy term and invest the rest philosophy. That's very easy for me to do, right? I have good savings habits, I have good investing habits. I'm also really well informed in investing and in financial planning. It's my profession after all, right? But I cannot expect every other person out there to be exactly like me. Like that's not a fair assumption to make. And so I agree with the philosophy of buy term and invest the rest. I understand that's good rationale. But I also want to be honest and acknowledge that not everybody is going to work with that technique. Like Danny, we're just talking about 60% of people can't come up with $1,000 in an emergency. I would be willing to bet a lot of money that those 60% also are not going to be able to buy term and find money to invest the rest, right? It's just
Definitely.
likely not going to happen. So to your point, Danny, about the forced savings, if you're one of those people where you need to be held accountable and paying something like a life insurance premium where there's risk on the line if you don't pay it, right? Your policy could lapse. You could lose precious death benefit and cash value, right? You're on the hook. Like you puts the fire under your feet, so to speak. If that motivates you to have better savings habits in good faith, I can't tell you to not do that. Like that makes sense for some people. And I acknowledge that. So I think those are some of the areas that, whole life or infinite banking, if that motivates you, if you jive with that kind of concept, maybe you're a good candidate to consider something like that if any of these things spoke to you. But Danny, I want to talk about some of the risks as well with infinite banking. I think the
Sure.
biggest one, and this is the one I really agree with a lot of people on my side of the aisle on the kind of the fee only planning side, opportunity cost. I have my whole life as a self-contained emergency fund. I could take it farther, right? I could go beyond that, but you have to acknowledge that these things require a lot of capital, right? And so they're highly capitalized policies, and that means for people who are trying to start from scratch, like there's an opportunity cost there, right? Now, I want to take a minute and defend whole life a little bit because a lot of people paint it like, well, like you said earlier, Danny, it's all or nothing. Like you put your money in whole life, well then you can't contribute to your Roth IRA and you can't pay extra towards your mortgage, blah blah blah. That's not true, right? We just talked about the flexibility of this thing. You can still take policy loans, right? I can very easily see somebody funding a whole life policy, but they also still want to make their Roth IRA contribution. They have enough stable cash flow from their job that they could take a quick policy loan. They got the whole life up and running. Getting it started early when you're young and healthy is an optimal time to do it, right? You could fund it, you pay your premium, maybe you take a little bit out to help you make your Roth IRA contribution, but your cash flow is strong enough to quickly pay off that loan back and get your cash value back up to whole. And maybe you pay interest on a couple months. Like big deal, okay? Right? Did you truly forego your ability to ever contribute to something else because you put your money in whole life? Probably not. It's a flexible asset. Like it's not an
Sure,
either
that's fair.
it's not an either or, right? You can
And
use it and
in that
also do other
situation,
things. In that situation, right?
I
Yeah.
could see you doing that if it's near the end of the year
Right.
and you need to make sure that you hit your limit, right? Your contribution limit before that chance is gone forever, right? You
Right.
have until what is it? The following tax day, the
Generally April
tax day of the
15th
following
yeah.
year. Yep. To fund that prior year's contribution. Maybe you just needed you didn't have the cash flow to fill that up at that point.
Right.
And so you take that policy loan and now you can have that contribution knocked out and then pay back that loan.
Right. I agree. I'm fully admitting opportunity cost, right? Like it requires a lot of capital. And yes, you might forego opportunity in other areas. I think it's unfair for people to paint it as an absolute definitive either or. Like if you put your money in whole life, that is money you absolutely, under any circumstance, it's just gone forever. You can't use it. You can't use it to fund other goals or do other things. That's just not true. There is flexibility there. We have to give credence and acknowledge that. if we're being intellectually honest. So, but there is opportunity cost as a risk. Another risk, constructing well-designed policies is an art and a science. It is a skill set. There's just an inherent risk if you're going down this route that you may have a poor or suboptimal policy design, right? And even people who claim to be experts at it or who claim to be infinite banking practitioners, they may not actually be skilled in creating an optimal policy. I mean, I've fully spilled the beans, right? Like we're talking policies where agents are reducing their commission big time, right? Like there's not every agent is going to sell that policy. I would say most agents won't. In fact, a lot of people that I called out earlier, Better Wealth, Caleb Gilliams, and I know he's mentioned this on his channel before, that they have gotten flack from people in their colleagues in their industry for like spilling the beans on these types of policy designs, because
Interesting. Okay.
you would have to sell multiple policies that have high PUA, low base, just to equal the same commission you could sell with one policy
From
that's 100% base, right? And so
Absolutely.
like they're ticking off some of their colleagues in the life insurance industry, right? And
I mean, we're not going to dive into this, but I wonder if agents have seen a decrease in the number of people willing to buy that standard base whole life policy as this information has come out.
I think they have. That's my suspicion. And this is just from my own observations. I don't want to get too nerdy here, but when there was a change to section 7702 to life insurance assumptions, where the guaranteed interest rate on permanent cash value policies like whole life prior to the change was 4%. So by law, life insurers had to use 4% as a minimum guaranteed interest credit to the policy. Now, that's a gross number before insurance charges come out, but they had to use that number, actuarially speaking, to design cash values and death benefits and the intersectionality of how they are related to one another and how the glide path of how cash value grows to ultimately equal the death benefit, if you will. The new law it came out when we were at ultra low interest rates, right? And remember, life insurers operate primarily in the fixed income space. That's how they derive their yield in their general account. And when this section 7702 law passed, they were allowed to lower their guaranteed interest rate to as low as 2%, so cut in half now for policies moving forward. Not everybody did that. The guaranteed interest rate on a lot of policies now is anywhere between 2 and I think 3.75%. So it just depends on the type of product. But when all the illustrations came out post 7702 change, I made a lot of interesting observations on some of the illustrations regarding how the guaranteed cash values grew versus how they did in the past. And one company, the illustration, the guaranteed values looked more attractive on the base premium than it did on the PUA. And I thought that was an interesting nuance because generally it was the opposite. Like the more cash you're putting in, the quicker it's growing on the guaranteed rate. And I wondered,
that's what you would think.
I am wildly speculating here. This is my own observation, so this could be totally false. But in my mind, I was like, I wonder if that's a subtle nod to give some more ammunition to agents who want to sell an all-base policy to be able to point out, hey, look at this all-base policy. The guaranteed cash value is actually higher at this point in time than the PUA blend. And I thought that was interesting. Quick shout out on guaranteed versus non-guaranteed. When you're looking at whole life, there's guaranteed cash value accumulation and then there's non-guaranteed. The non-guaranteed portion is the guaranteed plus the dividend surplus. The non-guaranteed is exactly as it says, non-guaranteed. But a lot of people will say, like, when you look at these things, you got to look at the guaranteed section. That's like me saying, when you invest in the stock market, you have to assume in your retirement scenarios that it returns 0% every year for the rest of your life, right? It's just like not a fair comparison. Yes, dividends are not guaranteed, but a lot of these big mutual companies have been paying dividends for literally, in some cases, over 150 years through every world war, through every Great Depression, through every Great Recession, you name it.
They're not dividend kings or dividend aristocrats. They're the dividend emperors.
Yes, dividends are not guaranteed. I acknowledge that. But you should also be realistic in what you assume. I own a whole life policy. I am not going to assume that they're going to cut the dividend and never pay it again for the rest of my life. That would not be a realistic assumption. Is it possible? Yes. But is it realistic? No. But anyway, I went way down the nerdy rabbit hole, but we're at the end and we're like well over an hour and 20 or 30 minutes at this point. So we're bonus round. Anybody sticking around this long, you're getting some real nerdy deep dive stuff. But anyway, another thing, risk of infinite banking. You might pay more interest. You may be trying to do some arbitrage play with the growth of your policy and the intersection with the policy loan provision and the interest rate on that versus the alternative of getting lending elsewhere. It may not always be to your favor. Just acknowledge that, please. Nothing you can do, Danny. This is nothing with flexibility that I didn't even mention. You can collateralize your policy. You can assign your policy, for example, to a bank, and they can lend you a line of credit using your entire policy as collateral. And
interesting. Okay.
It's because it's a super flexible asset. You can assign it to anybody you want. And in some cases, these lenders, I don't think right now with interest rates being high, I don't think it's the case, but some time ago, there were banks or other lenders who would be willing to be a collateral assignee, use your policy as collateral, and in exchange give you a loan or line of credit. And the interest rate is sometimes very attractive, like a bit less than what your policy loan is. And not to get nerdy, but if you happen to have a policy that is direct recognition and your policy loan would negatively affect the dividend that is credited to the portion of your cash value that has a loan collateralized on it, one way you could skirt that is by doing a collateral assignee with a third party. They give you the terms of the interest rate. You never have to take a policy loan. Therefore, you're preserving the full dividend crediting amount to the full cash value, and you still get access to a loan.
Okay.
So that's another thing that is a flexibility feature. But anyway, you could still pay more interest. That's something to be mindful of. Another one, policy lapse or MECing your policy, modified endowment contract. We're not going to go into the details here, but there is a risk. Like on my policy, for example, because I have a high PUA and a low base, it says on the illustration that like in year 47, when I'm like, I don't know, years old or something. I don't remember, forget what age, like 70s or 80s. It says my policy will become a MEC at that time. And that is because it is at that time that my policy fails the 7 test premium, the 7-year test, 7 premium test, forget the name.
7-year pay test.
Thank you. Gosh, I'm losing my brain at this late in the recording. The 7, that what you just said. Now, that doesn't mean it's doomed to become a MEC. I could just simply not pay my premium. There are ways you can avoid that, but
okay.
The risk is when your policy is structured, a well-designed policy, the agent is going to try to push that policy, like kiss it right up to the MEC limit, right, as close as possible without becoming a MEC, because that's going to make the cash value accumulation that much more efficient and more robust.
Hey, we've got a new shirt design. Kiss the MEC.
Oh, I could take that further, but I'm going to stop there. You're really trying to get close to that. Now, here's getting into the nitty gritty. You can be conservative or aggressive with how you're MEC testing it, right? Some people will design a policy, and when they're designing it, they're saying, I don't want this thing to MEC under any circumstances. So for the MEC test, I'm only going to use the guaranteed portion of the dividend. Forget any of the non-guaranteed portion. I don't want it to MEC even under guaranteed situations. That's a really conservative approach. If you're comparing apples to apples of two policies designed exactly the same, but somebody was more conservative with how they built the policy when testing the MEC limit under a guaranteed situation versus a non-guaranteed, you can make one policy look a lot better than the other from internal rates of return by being a little more aggressive with your MEC testing. That's the best way it's been described to me. I've not done these illustrations, but so if there are any agents out there hearing this, perhaps you could comment and speak more to the nuances of this. But the risk is, if you're using an assumption that your policy is your death benefit's going to grow based on dividends paid. If dividends get cut, there's a risk that your death benefit is not growing at the rate that was originally illustrated. And if you were designing the policy to not MEC based on that death benefit hitting a certain target, remember, your death benefit has to be high enough at any given time on that 7 pay test relative to the cash value. If your cash value gets too close to the death benefit, it can MEC the policy. Well, if dividends get cut, and that's less paid up additions on your death benefit being purchased into the future, you run the risk that you could MEC it in the future, right? That's something you have to be mindful of as a risk.
That death benefit needing to be high enough is the same reason that people will also sometimes put those term life riders onto whole life policies.
in the cases we've been discussing, it's virtually a
Okay.
necessity. You basically need it unless you're going enough base premium, because base premium generally purchases more death benefit earlier on. But yeah, that's generally the case. But anyway, I do mention that because that is a risk that you have to manage and be aware of. It's not, these things don't sneak up on you and just blow up in your face, right? Like you're gonna be sent notices from the life insurance company, like, hey, your policy's about to mech. Did you mean to mech it? Like, did you mean to, like, they don't just let it happen out of the
Yeah.
blue, right? Assuming that your mail is coming to the right place, and you're checking your online messages, they're gonna notify you. So you generally have time to take corrective action and make sure that things are okay. But it is something to be mindful of, right? That's a risk. Policy lapse is another one. If you're like going back to the become your own banker, Nelson Nash, if you're not being honest banker, like if you are just letting your loans run wild and you are not doing anything to keep an eye on them, and that loan value exceeds your cash value, the policy is going to lapse, right? So that's something you have to be mindful as well. Yeah, I think the last thing, Danny, and then we can close this conversation, which has been a beast of a conversation. This is the last risk I want to mention. And it's kind of tying back to some of the sensitive things we're talking about from the book. But
Sure.
in general, like, this is just my 2 cents. Whenever somebody is trying to convince you of an idea and they get extraordinarily passionate about it, put up some level of skepticism. Be mindful of, don't fall into an echo chamber or get caught up into groupthink or fear of missing out, or something, some idea that seems so sexy, right? Like it just draws you in. It sounds unbelievable, wonderful idea. I don't know. There's danger to rhetoric,
Yeah.
right?
I'm gonna combine some analogies here.
Yeah.
If infinite banking is a hammer, realize that not every problem is a nail. Thought you might like that.
Man, you nailed that one. That was a good one. Remember, I mean, this is just whole life, and how you use it is just a tool after all, right, Danny? It's just a tool.
Yep.
Yeah.
Your financial tool belt, toolbox, whatever you want to say.
Whew, Danny, I think
We're tired.
We're at the end of the line. Listeners are deep bonus round right now.
Yeah. Groaning as they drive home or drive to work. Who knows?
I know, right? I would be surprised if anyone listened to the whole thing, right? Oh gosh,
I'm gonna end the recording right here.
You know who I wish wrote the infinite banking concept?
Who?
Buzz Lightyear. Because then he could take us to infinity and beyond. Anyway, I'm gonna stop there. We're gonna stop.
All right, that's it, everybody.
Thank you so much, everyone, for sticking through. If you did, honestly, it's a controversial topic. It was a lot. We slugged through it. Maybe Danny will revisit portions of this in much smaller bite sizes in the future.
I think so.
But wanted to share our thoughts on it because a lot of people, I've had many people come up to me personally and ask me, like, have you heard of infinite banking? Like, is this a good thing?
Mm-hmm.
And I've heard it so much that I felt compelled that I had to share my thoughts on it. And I really hope that you got some value out of this. We spoke about a lot of sensitive things. There's a lot of passion in this topic. Hopefully we're respectful of everybody. We really do want to meet people halfway and be honest and fair and reasonable. And we hope we came off that way. And if we hadn't, apologies. If you have thoughts to share that you think would complement or supplement some of this discussion, for or against anything we said, this is an open space to talk, right? We invite that. So feel free to leave a comment. And we appreciate you sticking around and coming on this journey with us. Danny, thanks for sticking with me through this nerd storm, as we always do together. To our listeners, have a wonderful rest of the week, and we'll see you next time.